Well, good afternoon. It's Merle Dimbath again, your optimistic economist. Wednesday afternoon, and the Federal made its decision today to make no decision. They are keeping rates constant as they've been since last December. And I'm talking now about the so-called federal funds rate, the very, very, very short-term rates that guide banks and their lending to each other, and what the Federal Reserve charges banks when they borrow from the Federal Reserve. And apparently it's going to be constant for at least until September when they meet again. But let's go ahead and look at some numbers. We'll go to federalreserve.gov, and the main page, Board of Governors of the Federal Reserve, appears. And we'll click on selected interest rates. And we'll scroll down, and here's the latest information for July 30th of this year. And as we can see, and it is a little difficult to see, but I'll adjust it here, the federal funds rate is at a midpoint here of 4.33% in terms of the actual rates that are being charged banks when they borrow from each other. It's kind of in the midpoint there of the 4.25% and 4.5% rate. Scrolling on down, at the high end is the rate for the discount window, 4.5%. That is the rate that the Federal Reserve Bank charges member banks when they borrow from the Fed to take care of any short-term problems that they might have in terms of meeting requirements. And right above it is, of course, the prime rate, and this is what banks charge their best customers. Okay, next we will type in BLS.gov, Bureau of Labor Statistics, so we can get information here on the Consumer Price Index. Chairman Powell, in his announcements today and statements to the press, emphasized the concern that the Fed has for inflation. That is one of their mandates, to follow this, and it is quite a bit away from their goal of 2%. In the latest numbers, the Consumer Price Index was 0.3% for 1 month. On an annual basis, that's 3.6%. That's a long way from 2%. And if we look over here at Consumer Price Index, well, I just lost it, but on an annual basis, it was in the high twos. Okay, I have the table back. And for the 12-month period from June to June, June 24 to June 25, 2.7%. So we can see that the Fed's goal of 2% is still not being reached, and may not be reached for some time yet. And that is, of course, a concern, because that has been their goal. Now, a 2% rate of inflation may not sound very high, but long-term, the implications are quite significant. I have a chart here that shows the impact of inflation at a 2% annual rate over a period of time. Let's suppose that starting in some period, say now, there's $100 of price. At a 2% rate of inflation a year from now, it would be $102. Okay, fine. But after 5 years, it's not just $10 higher, it's 110.41, because inflation is compound interest. This year's inflation is on top of last year's inflation. After 10 years, because of compounding at 2%, our original $100 price is now up to $128. After 20 years, $148. After 30 years, $181. And notice, after 35 years, it has nearly doubled. For all practical purposes, it has doubled in 35 years at a 2% rate of inflation compound. Now, what that means is, suppose that you are in your 20s or 30s, and you're planning for retirement. By the time you retire, today's prices, assuming that the Fed achieved its 2% annual rate, would be doubled or more. Something to think about. And particularly if you're in your 20s and thinking about retirement, by the time you retire in your 60s or maybe around 70, assuming that the annual inflation won't be any higher than 2%, you are looking at a doubling, could be even a tripling of inflation of a price as a result of of inflation. Now let's look at an annual rate at 2.5%, which is more in line with what our recent experience has been. 2.5 doesn't sound very high, but notice the $100 in a year is 102.50. Okay, that's understandable. But after five, as a result of compounding, it's $113.14. Notice that by the time we've passed 30, we have more than doubled, $209.76. And after 35 years, $237.32. This shows the power of compounding, but it also shows the danger of inflation over a period of time over your work life while you are working and earning and hopefully trying to save and prepare for retirement, that even at a very modest rate of inflation, by the time you retire, prices can be double, triple what they are today. And if you allow for an unusual situation like we had with COVID, where inflation was not just 2 or 2.5%, it was up 7, 8, 9%, sometimes even more, you can see the implications here because inflation is built into the structure of our economy. It's not a question, will we have inflation? It's only a question of how much. For example, the Fed, they have a goal of 2%. They don't have a goal of no inflation. They have a goal of 2% inflation, which, as we can see, over your lifetime can easily see a doubling in the price of products that we buy. There are some changes that I think could be made at the Federal Reserve that hopefully would improve its operation. Number one, I feel very strongly that we should repeal the dual mandate that includes employment as a policy goal. I think we should let the Fed concentrate on inflation and the supply of money and credit. That was the original intent of the Federal Reserve. It was during the Carter administration that the Humphrey Hawkins bill was passed, which, among other things, included a mandate for the Federal Reserve to include in its policy-making decisions considerations of employment and the unemployment rate. And that may have sounded laudable at the time, but as the saying goes, no man can serve two masters. I think that was in the 6th chapter of Matthew, but be that as it may, the Fed is torn in two different directions. In fact, in his comments today, Federal Reserve Chairman Powell mentioned about the dual mandate and the considerations that they try to give to that as the legislation requires. But I think it's time to reconsider that, and I'm very much in favor of the Fed concentrating on what it's really intended to do and what it was created to do, and that is to look after the banks, control the money supply, and look after the supply of money and credit, and specifically make sure that we have a sound dollar and control inflation. Another thing that I think should be done is cease paying interest payments to member banks when they make a deposit at the Federal Reserve. As I indicated in my previous report last week, the central bank is basically the bank for the banks. And as a bank for the banks, banks can have a savings account there, and it's not really called a savings account, it's called reserve deposits, but they earn 4.4% on those deposits. And those deposits could be better employed, in my opinion, by providing loans to businesses for expansion and for consumers for purchasing cars and houses. And by paying 4.4%, we are giving basically an incentive to the banks not to make loans, but to just have idle funds. They don't have to do anything, just park the money at the Fed. So I think it's time to rethink that. And historically, the Fed is a profit-making organization and would distribute profits to the Treasury. For every dollar of interest that they pay to the banks, that's a dollar less that could be distributed to the Treasury, which the Treasury could sorely need, and sorely use to help reduce debt and balance the budgets and be less reliant upon borrowed funds and so forth. So I think this is something that will be considered hopefully in future sessions of Congress. And then Finally, I wonder, why do we have to have these meetings every 7 weeks? They are disruptive. The markets get all excited about them. It's a media circus. Um, Economic phenomenon take more than just 7 weeks to materialize and manifest the implications of whatever trends are underway. In fact, Federal Reserve Powell today in his remarks to the media indicated, well, they're waiting for more time to see what happens with reference to tariffs. They're waiting for more time to see if there's any implications with reference to employment. They have not made any change since December. If they make a change in September, that will have been 9 months. That could have been 3 quarterly meetings. What is served by having these meetings every 7 weeks? I realize this may take a change in legislation, but it seems to me to be a waste of time, energy, and an unnecessary amount of hoopla and distortion uh, of what's going on by having these things every 7 weeks. And even if the Fed did make a change today, and making a small, maybe a half a point or a quarter point reduction in the federal funds rate, these are very, very short interest rates. It's questionable how much of an impact they would have right away on long-term rates, particularly mortgage rates. It's interesting to look at the rate of return on U.S. Treasury bonds, anywhere from the 1 year bond all the way out to the 30-year bond. Bonds were generally up today. The 10-year bond is very actively trading, and as we look here, we can see fluctuations of slightly negative to slightly positive. Bottom line, the 10-year bond is about 4.36%. And you consider that this is a bellwether, this is a key bond rate that influences significantly mortgage rates, 30-year fixed mortgage rates. Mortgage rates are very often anywhere from 2.5% higher than the 10-year bond. So 2.5 points above the bond here would indicate, of the 10-year bond, would indicate an interest rate in the high sixes, close to 7%. Not exactly what we want to help stimulate the housing market. Again, underlying the importance of having the Fed concentrate, focus their attention on the money supply, on interest rates, on inflation, and leave it to other government agencies and private enterprise to look after the employment situation. Well, that wraps up my report here for the Federal Reserve decision-making process today. I hope you found some of the data interesting. I'll be publishing my regular weekly report again this weekend. And again, I'm supposed to ask you to please subscribe, hit the subscribe button. That I've been told that's a very important thing. So if you could do me a favor, do that. And I'll talk to you again soon. Goodbye. Your optimistic economist, Merle Dimbath.